Now we're going to talk about two of the principles of ethics, namely competence and integrity, and how the requirements for suitability and disclosure in delivering insurance service to clients is presented. We'll cover the requirement of that it's incumbent on insurance producers to ensure client understanding concerning any proposed coverage and its issuer, the insurance company. We'll discuss disclosures that should be made concerning the insurer offering the recommended insurance coverage, the insurance coverage itself, and the illustrations employed in presenting it, its general tax treatment, alternatives to the recommended coverage, and requirement for a balanced disclosure of advantages and disadvantages. We will conclude this with this discussion of suitability. Let's consider some historical background. All right. There are several legal doctrines that come into play with when people were conducting businesses at the beginning of the 20th century. Caveat emptor and was one of them, right? Let the buyer beware. We've heard this often, haven't we? People back in those days, before there were all the regulations and fairness and trying to help clients and insureds, it's like, okay, you buy it, you're stuck with it. And there was no implied warranty of fitness. We talk about products liability and people getting hurt from bad products. It didn't matter. And that these laws were very unfriendly to consumers. The prevailing legal doctrine in effect in the United States, and which continued into the decade of the 1960s, was referred to by the Latin name caveat emptor, let the buyer beware. You had no implied warranty of fitness. If you got somebody sold a product, they didn't have to warranty it. It didn't have to work when you walked out the door. You're supposed to be sufficiently knowledgeable about the product you bought to adequately evaluate their ability to use the product and for the product to do the job they were purchasing it for. There were very few disclosure requirements. Fast forward now, we have to disclose everything. Hey, dummy, this is hot. Don't dump it on your lap. I mean, you kind of wonder sometimes, but that just where the legal issues have changed. Buyers are generally able to hold sellers accountable for the product's failure, excuse me, only in two cases. If the seller provided a written guarantee, which you probably wouldn't see too many of, or if the buyer could prove the seller was negligent in making or selling the product. So if you didn't have a written guarantee and it didn't work when you got it home, you're often out of luck. Some of these products were dangerous and caused injury or death. And if only if you could show that in court that the manufacturer was negligent, and you probably didn't have as much money as the manufacturer did to pursue the court case, then only then would they be held liable and maybe you'd get some money back for it. By the mid-20th century, consumer protection advocacy was growing. We wanted more protection for consumers. It wasn't fair that the manufacturers held the upper hand when they were making all the money on this. So it's a significant shift. Who can tell me and does anybody know what the new doctrine was that generally prevails today? It wasn't caveat emptor, it was caveat venditor. Let the seller beware. So that's a complete shift in perspective and in ideology. Yes, we've come a long way in terms of product liability and consumer protection. Unlimited product liability was applied to the manufacture and sale of many products that were deemed to present a significant risk of injury or death to consumers. No longer did the buyer of these products need a written guarantee or be required to prove negligence because they were perceived as being dangerous. This guarantee does not extend to insurance products and their sale, but the current legal sentiment is far more consumer friendly today than in times past. We talk about the fact that anything that's unsure, unclear, it goes to the client's interpretation. If it's not clear, if it's not specified, the company is going to have to pay for it. Ambiguity, anything in that respect. And there's an implied warranty of fitness and demands much more from sellers with respect to providing information about the products their clients purchase. So it requires both appropriate disclosure and product suitability. We talked about ethical practices of integrity with the two requirements on insurance producers, that they be honest and candid in their delivery of insurance services. In practicality, this means we have an ethical duty to ensure our clients are fully informed. And how do you do this? There are 4 areas about which a producer has an ethical, having to put warning not to eat the Tide Pods. Yeah, hello, another one. Crazy, right? If there's 4 areas about which a producer has an ethical obligation to make their clients fully informed, what do you think they are? Everything. Thanks, Terry. Perils covered, not covered, cost. All right. Well, who's the insurer? What is their rating? How to file claims, right? What's covered? How much? Coverage, cost. Just looking at the answers. Who's the insurer? What's their rating? Is there, do they have a best rating of A plus, or are they a B or a C? Proposed coverages. What do we get? What are you providing? Illustrations of how maybe the coverage would apply, or how the deductible works, or how the various deductibles work. Are there any tax ramifications? Obviously, in some of these life insurance and annuity and programs, those kind of things would have tax implications. How the market is trending. What is insurance? I don't know what insurance is. Do you know, Matt? Mandatory documents from the insurance department. Definition of professional services. Exclusions, conditions. Terry says, I use examples a lot as customers are usually deer in the headlights. Exactly. They don't know. They don't understand. So we have an ethical duty to ensure that our clients understand all the material facts concerning any recommended insurance transaction. Full disclosure of any material facts about the insurer, the coverage recommended, any illustration used the recommendation, and the tax treatment to which the coverage is subject. We've used an important word in describing these requirements, and that word is material. What do we mean when we say a material fact? What does the word material mean? Documentation is important. Yes. Something that will affect the product. Physical change. And you didn't see the poll, please let me know you're still here. Significance. Material facts are ones that are important, relevant, and likely to make a difference. The color of the paper that the policy is printed on is not a material fact, unless, of course, you're colorblind. So we talk about a fact being material. We're talking about facts that would be considered important to the client, relevant to the decision concerning the product, and likely to make a difference in their decision to accept or reject your recommendation. The most important consideration is whether the insurer is likely to be in business and able to make payment of any claims. We've seen numerous instances where real big insurance companies went and were no longer there, and the various insurance guarantee funds or the government had to step in and help out. So you kind of need to know if you've got a thing that's going to be there to pay your claims. So financial strength, claims paying ability, so they can make a more informed decision. We can look at the various organizations that do the rating, like Standards & Poor's, AM Best, Moody's, Duff & Phelps, Demotech. There are a variety of rating organizations that can provide information, and maybe you want to point them in that direction. You can't always share that information with the client because it's often proprietary to the rating organization. They don't want you sharing their materials without somebody paying for it. So be careful. That's ethical. Don't be sharing information that you don't have a legal right to share. Disclosures of information about the coverage are also important, right? Depending on what kind of coverage it is, and it will tell you how much disclosure you need. You're required to disclose anything at minimum about the coverage that can reasonably be expected to be relevant to the client's decision. We talked about deductible. That's a big one. How much is the deductible? Is there a cap on claims? Is the liability limit decreased by payment of claims, or does it come back? Presence of exclusions or limitations or any guarantees provided in the coverage, and the risks and exposures that are covered. For example, with life insurance and annuities, you have computer prepared illustrations to say this is what you're going to be getting and this is what your return will be under various interest rates and different assumptions about expenses. So they may look at some of these high values and high rates of things that are not non-guaranteed, say, oh, I want that, I want that. Well, maybe that's not the best, depending on your situation, because it's not guaranteed. So even though it says even though it may have gotten 10% for the past 10 years, next year they could get 0% or negative. You just don't know. So some of the things you would want to disclose are the tax treatment of the premiums, tax treatment of benefits. I just went through that with my mother's estate. We got money from her investments and money from her insurance, and which stuff is taxable, which isn't. Getting the forms from the financial institutions, pulling teeth. But that's something to consider. Tax treatment of surrenders, withdrawals, and loans. What if you take out money? If you take money out of your 401k to buy a house or to pay something, what are the tax treatments of that? What are your early withdrawal penalties? Not exactly insurance, but kind of in the same vein. So it'd be improper for a producer to provide specific tax guidance for a client unless you are a tax professional. We've discussed that before. But you could discuss the general tax treatment, whether the premium is paid or deductible or non-deductible, whether the benefits received are included in gross income, how the proceeds received under the policy are, as surrenders, withdrawals, and loans are taxed. So remember that ethically, your objective is to sell the product to a client who is fully informed. So that means you have to disclose the alternatives that it might be available to the client for managing the risk. What alternatives are traditionally available to clients in their efforts to manage risks? We're talking about risk management. What are some of the things you can do as an alternative to buying insurance? Self-insure. There you go. That's a good one. Pay out of pocket, self-insure, pray. I like that one. Group association, higher deductibles, self-insure, contractual risk transfer. Thank you, Lydia. So we talk about you're avoiding when you're looking at a risk, you've got something that your exposure that you're looking at. You can either avoid it, you can control it, you can retain some or all of it, or transfer it, can't you? So maybe you want to reduce the financial risk to your family if you're of dying in an airplane crash. Well, you can avoid it by not flying in an airplane, which may not be feasible depending on your situation. So you avoid air travel. If you want to control the risk to which you're exposed, what if you're worried about house fires? Well, let's make sure you've got your smoke detectors and your carbon monoxide detectors set, that you clean your chimneys and your wood stoves, that you have they have those blankets that you can put on a fire. Don't leave cooking unattended. Most home fires begin in the kitchen, don't they? Sprinklers could help control the risk. Some things we can't control or avoid, can we? That's where we come in. Our insurance gurus learn how to work a fire extinguisher. Yeah, preferably before the stove is on fire. And make sure it's charged. And even your smoke detectors, they only last a couple years. So make sure that those are up to date and that they are actually monitoring the level of carbon monoxide or whatever, rather than waiting if it gets too high. Maybe it comes, sometimes these smoke detectors and things don't register until after it's too late, because if you're asleep, you're already going to be dead by the time the carbon monoxide alarm goes off, which is kind of scary. But we're in insurance, we're in risk management, and that's what keeps me up at night. Could retain the risk. You can entirely retain it. Say, okay, I'm going to be self-insurance. Health insurance is moving towards fixed funding, mix of self-insured and fully insured. Yeah, you may not want to insure it, but you may want to retain it and say, okay, I'll take it on as a risk. I can afford it, or I can afford a certain amount, and I'll buy an excess layer above whatever amount I'm comfortable with. Co-insurance or deductibles involved. Few clients are probably likely to avoid, control, or retain the risks they have. They want to buy insurance and not worry about it, don't they? But if you tell them about the alternatives, they may think about different things. If they're worried about the expense of the insurance, if they're worried about whether they can afford it or not, then you want to say, okay, if I do this, I retain this risk, or I transfer it to somebody else. Somebody else builds that part that is dangerous, that may reduce my risk. Increases the transparency of the insurance transaction because it reinforces the suitability of the client's decision to transfer the risk by purchasing insurance, and helps to differentiate your insurance practice based on its ethical focus. We're trying to do the best. There's little question most clients, when they understand the alternatives available to them to manage risks to which they're exposed, will choose to insure. When they choose to insure the risk, you're ethically required to make a balanced recommendation. When you talk about balanced recommendations, what do you think we're talking about? The polls are pop-ups right on the screen. So they come up on top of the PowerPoint. And I just shared the results. So you work remotely. Most of us work still pretty evenly balanced. I obviously work remotely because my office is in New Jersey and I haven't been there in 10 years at least. So I don't know why it's not. Maybe it's behind. I don't know why you're not seeing it. It's bizarre. Okay. So balanced recommendation. Talking about the different required disclosures. Just keep checking in every little bit, Lydia, just so we know that you're still here. And Connie and Carrie and anybody else who has not seen the polls. If you have seen the polls, I don't need to see, you don't have to put it in the chat. But if you haven't seen them, please let me know. And there should be about 4 of them this time. Okay, listen for things like, when you're talking about a balancing recommendation, what are the costs? What are the disadvantages? What are your concerns? You have to balance the discussion of the features and benefits of the coverage with a disclosure of its costs and disadvantages. I mean, sure, it's great coverage, but it's going to cost you $1 million. Maybe you don't want that. You can't cover everything. You want sometimes. And if you're an insurance company, you can't exclude everything. So what's the direct cost and what any indirect costs that might be? Direct cost is the cost of the premium, cost of the deductible. You may have an audit requirement. You may have to fill out information, provide reports. You may have to allow an inspection, an annual inspection. You may have to do questionnaires. These may not be significant costs, but they are a cost because it takes time away from what other things you're doing. If an annuity involves a surrender charge, and they usually do, you need to tell them about that because you're going to have less money coming in. Julie says, we've been recommending higher deductibles due to increased cost of policies in the last few years. And historically, deductibles 100, 250, 500. If you can't afford the deductible, then that's another issue, I guess. Sure, there are some people that cannot afford it because you do get significant savings if you've got a higher deductible. We talk about complete comparison, advantages and disadvantages of your current coverage, and advantages and disadvantages of your proposed coverage. And what will your claims history be doing? Document. If you have claims and you don't disclose them and they turn around and find out about it, we talked about this before, they may cancel the policy, the new policy, and the old policy may say, yep, sorry, we're glad to be off you because you had that claims history. We don't want you back. Material elements of the existing and proposed coverage will vary. Things that you need to compare, depending on the type of insurance coverage that's involved, as we discussed. You're going to have a lot more detailed taxable and surrender values if you're talking about an annuity or a life insurance type policy. But you have to compare premiums, coverage limits. Sure, this is a great premium, but they're only giving you half the coverage, or your deductible is $50,000, or you're only covered for fire. You're not covered for any other risk. If the insurance being replaced is a life insurance policy or annuity contract, cash values, dividends, surrender charges, co-insurance. If it's life insurance, the comparison should include the expiration date of contestable and suicide provisions. The loss of grandfather tax benefits or imposition of surrender charges and any liability for tax penalties. If you have an impaired client, which we haven't really talked about yet, you have a lot of more ethical responsibilities, don't you? It requires making sure the impaired client understands or has somebody with them who is capable of understanding, who can help to make the decision. There may be impairments from vision, hearing, could be a mental issue. You may not even know. You may not even be able to tell. Somebody may be too proud to tell you they can't hear you. Or they can't see you. They can't read. Maybe they can't read. Maybe they're dyslexic. There could be any number of impairments that are going to impact their ability to understand what you're suggesting and what you're recommending. So we just talked about some of the different impairments: vision loss, hearing loss, cognitive impairment. So if you think a client has vision loss, you might need to ensure that the material you have can be read. Maybe you need to make it a larger font. Maybe it needs to be a different color or a different typeface. You have a profound and uncorrected hearing loss or diminished cognitive abilities. There's more significant concerns, aren't there? Because you may not be able to make them understand, and you may have to have a disinterested or third party or trusted family member or trusted business associate sitting in on the discussions. Maybe their attorney. In that way, they can help the client understand. Make sure to retain signature changing deductible. Yes, signatures on everything, right? And there's a reason why the applications say this must be signed by the insured. This must be language barriers, another good one. It's a perfect example. If I don't understand your language, or if English isn't my first language and everything's written in English, and the correspondence is in English, and the conversations are in English, and I don't understand English, there you have an issue there. Good one. If you think that the client can't make a good decision, if you don't think they can understand it, it may be best to walk away, because the implications down the road could be serious if you sell the policy to somebody who can't understand what it is they bought. Nobody likes to walk away from a sale, but in the long run, sometimes that's the best way to do it. Now we'll talk about suitability. Think about your last visit to your doctor. You had a problem with breathing, you had a headache, and they put a cast on your arm. Do you feel confident about their ability to understand what your problem is and to diagnose your problem? Would you run the heck out of there and find another doctor? Yeah. You're not going to go to an eye doctor for a leg issue. Your knees hurt. I'm going to go to my eye doctor. You're not going to go to a dentist for, a headache. Maybe you will, because maybe the headache is from your teeth. But so the basis of the suitability requirement is that the treatment be appropriate to the problem. It's been a legal requirement for many years, when the recommendation involved a variable insurance product, since variable products are considered securities. More recently, several states have imposed legal duty of insurance suitability beyond its applicability to various insurance products. Specific products, when sold to clients that are deemed to be particularly vulnerable to unethical sales practices. Could be a deferred annuity or a long-term care policy sold to older clients. There's the legal requirement that an insurance producer recommend and sell only. Yes, the common client impairments is still the one we're on. So we'll be on the next one in a minute. Sell products continues to apply only to specific products. There's not true of the ethical requirement. The ethical requirement that you recommend only specific and suitable products is always applied to all insurance products and transactions. What do you consider when making a suitability analysis for an insurance product? What kind of questions are you going to ask? Or what kind of information are you going to need? What do they want? What do they need? Sometimes the two are not the same, are they? I want to be covered for everything, but I need to be covered for such and such. Budget is good. Nature of the business, financial profile, ability to understand and evaluate. We talked about that in the previous segment. Can they understand what you're doing? Can they make an informed decision? Can they manage the product? I said before, you have audits. You have to do an audit. You have to do quarterly reports or however. I mean, there may be clients that cannot do that or will not do that. So maybe you need to find a different way to insure it. I mean, I remember having clients that had those reports and they just refused. We would never have the reports on time. And then the audits they come in and they get an audit that was $1 zillion because they didn't fill out the reports. And not only is that a problem for them for cash flow, but if there's a loss and their inventory reports or whatever their reports are not up to snuff, they're not going to get paid on their actual exposure. They're going to get paid based on the last audit they filled out or the last report they filled out, which could be 6 months old. And do you want to be the one to explain to them why they're only getting $50,000 when their inventory is $400,000? document, document, document. Can the product satisfy their needs and objectives? If you're 90 years old and have no heirs and have $1 million, you probably don't need a life insurance policy. But there are people who probably try to sell it to you. You have to consider both the client and the product. There are three important issues. Talked about their needs and objectives, their ability to understand and evaluate, and their ability to manage the product. Some other things to talk about. The current income. What is their income? What are their assets? What is their personal situation? As I mentioned before, if you're 90 years old and have no children and no debt and $1 million, well, life insurance policy, probably not. Doesn't make sense. What's your risk profile? How fancy are you? Do you like to gamble? Are you really risk averse? If you really want to make sure. Thanks, Pam. She sold the new poll. Hey, Carrie, glad you're still here. So an insurance producer must determine your needs and objectives. If the data gathering meeting is for the purposes of determining a need for life insurance, the client information should also include information about the income, the assets, the personal situation, and how well they tolerate risk. Make sure customer is taken care of above all. Okay, Lydia, thank you. If, in addition to understanding their needs and objectives, you need to consider their ability to understand and manage the product, which we talked about as well. You need to engage in a candid discussion of several topics. Results. Is insurance your first career choice? Shockingly, 78% of you said no. As I mentioned, I'm a plant science major. I deal with plants in my spare time. I was not in insurance, but I started in insurance in college and never left. I said I'm nuts. That's because I am. Okay. Ensuring the client's understanding. What's the risk that's being insured? I see your question, Sylvia. We'll talk later. What are the benefits? What's the policy going to pay? What are the conditions that the policy pays under? What are some things that are uncovered losses and limitations, your exclusions, your conditions, any non-guaranteed interest rates and expenses, contingency charges, things. As I said before, don't market yourself as an advisor or accountant unless you are one. What are the disclaimers? Michelle says insurance chooses you, you don't choose it. Absolutely. They have to have a broad range of issues that need to be discussed. Make sure they have enough information to understand the product that's being recommended. Be absolutely clear about what's being insured and the benefits provided. If the guy has two buildings and they're identical, and he's got boilers in both buildings, and he only wants to insure the old boiler because that's the one that's going to die, and he doesn't want to insure the new boiler because nothing could possibly ever go wrong with it, you make sure you've got in writing that that's what they want. So when they come back to you, sitting in the insurance company's office screaming because the new boiler died and you didn't have coverage on that because they only wanted the old boiler, and you say, well, I've got my letter here that said to you, you only wanted to insure X and blah, blah, blah. And here's our phone conversations back when we had the little pink memo pads of when you wrote down your discussions or whatever, your notes when somebody called. And I said, I've got the letter here that I sent you. He said, I don't read my mail. Well, you're a dentist, so you know how to read. The company said, oh, okay. You've got your documentation. We'll take it from here, sir. That talks about more about ethics too, about having your documentation, being able to prove that what you did was correct and that you offered them the coverage and they were too cheap to buy it. So that saved me in that situation. You must cover any perils or losses that are not covered. Flood is an obvious example. What is flood? What's covered? What's not covered? What kind of water damage is covered? We talked about, I just wrote updated an article about underground utility pipes and water pipes and from the house to the curb, which you're responsible for. And how are you going to pay for them to be dug up? Because it's not going to be your insurance company in most cases, unless you purchase service line coverage. But people don't always realize that until they have the water pipe burst in the middle of the night and they have no water, or their sewage line bursts and they have sewage in their front yard, or other fun things like that. So do they know that's not covered? What kind of things losses that could happen that you want to address and see how much it would cost. They don't have to buy the coverage, like I said, with umbrellas or equipment breakdown or all the other ancillary coverages that are offered, but you've offered it to them. They've signed off saying, yes, you offered it to me. I do not want this coverage. And you've got it in your file. Either your electronic file, because we all have all electronic now, or your paper file. And then when that loss comes back to you, you've got your information that you need. Stan? What are when you're talking about managing the insurance product, talk about now there's sinkholes. Yes, correct. Is it a sinkhole? Is it a mine subsidence? Where is it? What's covered? What's not covered? So if you're talking about how the insured can manage their product, premium affordability, it could be great coverage, but if it's $1 million and they've only got a $500,000 budget, we need to think about something else, don't we? If it were a variable product, how do you make your investment related decisions? Do they have somebody that can help them with that? And maybe they don't want a variable product if they can't make those decisions. Many products, such as health insurance, disability insurance, property and casualty, the only factor that may be considered is whether or not they can afford the premiums. But for certain life insurance and annuity products, managing the product can be more complex. Securities, if they're considered security, like a variable life insurance or a variable annuity, they have to make investment-related decisions. They can't make these decisions, then they may be unsuitable for that. The initial and ongoing asset allocations, the use of cash value management tools, or the transfer of assets from one account to another. So a lot of us don't sell these kind of things, but they are things to be thinking about. The overriding concern is the fit between the insured and the product. So you have to consider the product. You must enable the client to meet his or her needs and objectives at an acceptable level of risk in order for it to be suitable. Everybody buys on price, not coverage, right? Until they have a claim and they say, oh, I would have paid for that. I would have paid for that. So for P&C, basically, you just have to make sure that the recommended coverage is consistent with the type of property, nature of the risk, and the client's ability and desire to shoulder part of the risk for the deductible. And also understanding the nature of the risk, as we talked about before. You've got your questionnaires, you've got your surveys, you've got your reports, just so you can know what it is. Inspections. What is it you're really insuring? Is it a dress store or is it a cannabis shop? Couple different exposures there, aren't they? But if you're talking about a life insurance product, that you need to talk about how long the death benefit lasts. What is the importance of cash value accumulation? And whether they need flexible premiums or not. Because sometimes some of those insurance policies, the premiums change as the time goes on. They're not flat. You could be paying a lot more money in year 10 than you were paying in year 1. What's the death benefit? How does it get paid? You're 10 years old, Principal and interest guarantees and what surrender charges are. We've kind of touched on this before, so we don't need to really go too far into this. So we're about at time for our next, well, actually, we're not right at the time for the next break yet, but we could take it a little early if we need to. Any other considerations we have about client needs? How long will they need the death benefit? Important is the accumulation of cash value? How important is the flexibility of the premiums? Can I pay less now and then pay more when I'm making more money? Will the deferred annuity allow you to meet your objectives? We bought an annuity when my daughter went to college, before she went to college, and put that money and used that money to help pay for that. And my husband retired, so, and I didn't. All received. I see that. Oh, thank you. So you talk about the death benefit, the principal of interest guarantees, and the surrender charges and their duration, how they will affect the time horizon and liquidity required by the client. If they can't get the money, then it's not going to do them any good, is it? So let's summarize what we've talked about in this second hour. You need to ensure the clients completely understand recommended insurance transactions so that we have to make a full and fair disclosure of all the facts, the material facts. They're reasonably expected to affect the client's decision concerning the recommendation, including important information about the insurer, the financial strength, the claims paying ability, how easy are they to get a hold of. Can you call them and talk to them? Do they have a website that's 24/7 that you can do your claims? Can you submit your claims on your phone? Those things may all be factors in whether the insured wants to. Would you like to attend more MSI webinars? 62 out of 63 said yes. I'm going to find that 63rd person and say, what's wrong with you? No, I'm kidding. That's probably Vicky anyway. So we want to know the coverage that's being recommended, its benefits, limitations, and costs, illustrations that may be used to present the product so the client appreciates the possible range of results, and the tax treatment that may be given the recommended product, reducing deductibility, non-deductibility of premiums. We do have key life insurance. I mean, we don't sell insurance, things like that, but we do recommend things like key employee insurance. If you've got an employee that's running the whole show and something happens to them, do you have coverage for that? They, get hit by a bus. If is anybody else having a problem with sound? I mean, some of you won't say that you're having trouble with hearing me, but so it may just be an individual's internet or whatever. Okay, so everybody else seems to be saying no. But I mean, we all have internet issues from time to time. Where were we? Taxation of surrenders, withdrawals, and loans. Ethical duties to discuss into alternatives. We talked about avoidance. I'm clear. Sure you do. Avoidance, retention, transfer. We have transparency about how we're dealing with the client, letting them know the benefit to the producers by reinforcing the appropriateness of the insurance solution in the mind of the client. Retaining, controlling, different ways of pairing it. And in many cases, it is a balance, isn't it? That's why we have deductibles. Some people have a large deductible because they feel that they only want to pay if it's over 1,000 or 10,000, or a large company 500,000. Maybe I'm only worried about a catastrophic loss. But reinforcing the appropriateness of the insurance solution in the mind of the client by saying, well, this is what happens here, what your issues are, this is what you're giving up if you don't go with this insurance policy, or if you go with a higher deductible, or maybe you only want to cover certain perils. You're only worried about fire. You're not worried about water damage. You're not worried about other things. Fully informing the client about any other approaches they have will help him solidify your relationship with the client. They will trust you more because you are giving them alternatives. You're not just trying to take their money. And any things that are unsuitable may become very clear very quickly. You've got a client with 5 kids and starting up in business, a 500,000 deductible probably isn't a good idea. Insurance recommendations need to be balanced. You present both the direct and indirect costs of the transaction, as well as the disadvantages or concerns if the client implements your recommendation. We completed our discussion by talking about additional measures that need to be taken when recommending insurance replacement and working with impaired clients. The primary ethical requirement with replacement is that the proposed transaction must be in the client's best interest and not just because you're getting more money out of it. It must ensure that the client is fully informed what the transaction will do, whether they will, so they can arrive at the reasonable belief that they're not going to be in a less advantageous situation by purchasing it, that it's in their best interest. There's 3 important disclosures. We talked about the comparison of the recommended product with the product to be replaced. There's usually a formal proposal. Advantages and disadvantages of continuing the existing coverage. You may have a retro date. You may have, no, they're not. The slides are not advancing now. Identify advantages and disadvantages of the proposed replacement coverage. If they're fully informed, then they make the decision and it's not on you because they're the ones that are going to be impacted. You'll be impacted when they get mad at you, though, that you don't, if you didn't give them the right information. Talked about some different kinds of impairments, visual acuity, loss of hearing, diminished cognitive abilities. I'm fastly approaching there today. But you may have some vision impairment, and if they're not blind, you still need to be able to sure that they can read it. And how can they access the information? So the typeface, font, colors, all those things can be included. If they have hearing issues, maybe get a disinterested third party, get a partner or a family member to help with them, help to explain to them. There's no legal requirement for suitability in certain cases, but our ethical requirement is always applied to all recommended products. There must be a fit between the client's needs and the recommended insurance product. And that's why you have your suitability analysis to see if the fit really exists. You talk about the client's needs and objectives, their ability to understand and evaluate, and their ability to manage the product. So just make sure the product is capable of helping the client meet his or her needs and objectives at the level of risk the client can tolerate. And with that, we are on to our second break, 10 minutes, and then we'll be on our final hour. Please don't cry.
Sue, thank you. Very good. One more to.
Welcome back, everyone. Here we are in our last hour. Yippee! We'll talk a little bit about common sales tools. Obviously, with in CE classes, you don't talk about sales and marketing, but in ethics, there are things that you need to consider when you're operating in your business. What kind of things should a producer's business card say, or stationery? What kind of information would a client need to be able to find out from any of these, from your stationery, your website, name, email, phone address, contact information, specialties? That's a good one. Work hours is another good one. Designations. Agency or company name. Phone number, email, yes. So those are all good examples. Jean, you raised your hand. Did you have a question? Or is your hand just raised? Some carriers don't want designations on cars because it puts you to a higher standard. That makes sense. That's okay, thanks. I just want to make sure you didn't have an issue, since we seem to have a few. technical issues today. Okay. So identify the producer, identify the producer's business. Billboards is another thing, true. Identify the producer's role and what insurers they represent. It's good. So we talk about consistency in your honesty and your candor when you talk to clients. That also applies to your sales tools, such as the ones we just mentioned. So honestly and candidly accomplish three things. Identify the producer, identify your business or as an insurance producer, and identify the companies or managing general agents or brokers that they deal with. What's the principal ethical concern with these information on these business cards and stationery? What do you worry about? That they're lying? Don't overstate what you can do. Maybe they don't changes, right? Maybe they don't represent that company anymore. Accuracy. Yep. False claims, holding out, falsely claiming expertise, licensing or credentials. Because we're trying to be ethical, we're trying to have the client rely on us. And if we're lying about who we are, well, that doesn't say much about how ethical we are, right? So all of you make sure your business cards and things are correct. Same thing with advertising, mass mail, honesty. Okay. Misstating expertise, claiming unearned licensing, misstating achievements, obscuring services provided. I'm the number one salesperson in the past 10 years for the company. Yeah, too detailed could hurt in the long run. Exactly. So you're talking about your approach and your fact find exaggeration, promising uncertain benefits, misleading readers. All these things you can see you see all these brochures and mailings and things that sometimes, oh, we can do this, we can provide everything. You're fully covered. Fully covered. What does that mean? Fully covered. I mean, we're not even allowed to say all risk anymore because it's not all risk because there are things that could happen that are not covered. Means it's picking up yeah, hello, until they get rid of it, right? Stating results. We got this many sales, our investment results are this and that, and they're not. It'd be misleading. People think you're doing the things. No such thing as all risk, right? So in the sales process, in the fact finding steps, if you don't make reasonable data gathering attempts, and if you fail to make that, if that's unethical, you can't make recommendations without the proper information, right? Fully insured, fully insured. Yes, the client business card says they're fully insured, right? So talk about ethical concerns, the product selection, the product presentation, all in how it's presented, and that they understand exactly what it is that they're getting. Know your client better than the client knows themselves. Talked about suitability, their needs and objectives, understanding and evaluating the product, and their ability to manage the product. Intentional misstatement of the results that could be achieved by, or your failure to indicate their achievement requires the purchase of an insurance product could have a similar result. So we talk about comparisons and illustrations as part of the process. They need to be up to date and accurate. Fully insured is too broad. Yes. So your comparisons have to include the risks, the guarantees, what the insurance is, and what the tax treatment is. We talked about this in the previous sections. So in regarding the implementation and purchasing, did you actually submit the application and the money, the deposit, or is this in your top desk drawer because you're too busy? Did you actually get the coverage and get the binder? Did you issue a binder that you were not allowed to issue a binder for? Did you have the authority? Did you have even for things as certificates of insurance, everybody's favorite thing? Did you issue a certificate of insurance that you were allowed to? You had authorization to? Did you make a change on it? Well, then if you made the change on the certificate, that means it's not usually authorized. Did you not maintain the coverage for somebody? Did you not send in the renewal premium? As I talked before about accepting payments, did you reissue binders that expired in 30 days? Did you reach out to the company to make sure they got the policy request and they got the application, they got the money, that they're not waiting for something from you? Did it get lost in the mail? I mean, are you following up to make sure that everything's going according to plan? I mean, yes, we know a lot of times there are delays, but you need to be on top of it and working on your client's behalf to make sure that they are not stuck out there with an uncovered claim because you didn't do your job. Confirm and verify, and then verify again, right? And now we're going to talk about some case studies. Most of you should have the case studies that I sent you either last night or today for those of you who registered this morning. So we're going to identify unethical sales practices and to indicate the ethical treatment requirements violated and determine what the producer should have done. We'll look at our first one, which is you have the first one is, I believe, Hardesty, right? I go find my when insurance producers are completing this module, you'll be able to identify the ethical concerns that may arise, describe ethical requirements imposed on your tools. We talked about all that. So now we'll talk about the ethical analytics. Talked about the principles, the 6 principles. You belong to any professional organizations? A little more than half said yes. Good networking opportunities, aren't they? In other. All right, Ellen Hardesty, this scenario number 1. We're going to talk about the various ethical principles that we talked about previously and see how they apply to these things. My pages just got out. So, Ellen Hardesty. You've got take a look at this, and you should have the paper copy, or not paper copy, email copy. Take a couple minutes, look at it, see what you think could or could not have been done. And we'll come back and discuss it. So as we said, we identify the unethical sales practices, if any, indicate the ethical requirements that were violated, and determine what the producer should have done. And certainly, if you have any questions about the scenario, let me know. Changing something when she is happy with the current products, yes. Does she have enough money to meet her short-term cash needs? You see, her liquid assets are not counting the funds placed in the variable annuity amount of 653,000. So she would certainly appear to have enough money to handle her short-term cash needs. She has no current interest in using the annuity funds and expects they will become a legacy for her nieces. So her investment objectives seem to be long-term. They would extend beyond her lifetime. What do you think would indicate she would be likely to benefit from tax deferral? Yeah, fixed to variable, right? It's changed variable. Oh, it would scare me. I agree too. She files as an unmarried individual. $102,000 $300,000 income places her in a 33% federal income tax bracket. So tax deferral would probably be nice. She doesn't have a lot of deductions because she doesn't have any any kids. She doesn't have any insurance needs. We talked before about life insurance. If you don't have anybody to give the money to, I would be in an E&O exposure on this one. Most of us would be in an E&O exposure on this one, yes. She has $380,000 in the traditional IRA, so she has taken advantage of that in the past, but she has no earned income. All she gets is Social Security, pension, and investments, so she can't make any current IRA contributions. Moderate to risk tolerance and may be willing to take such risk to increase her potential returns. So the invariable annuity might have been suitable if you have the money that you're not going to be relying on it. But there's also problems are the tax treatment of the when you surrender the annuity, there may be tax implications. And if what was her name, Sharon, didn't tell her that there were tax issues and that she was going to have to pay taxes, that could be a significant problem. All contract gains on her original fixed annuity would be taxed as ordinary income in the year of surrender. If she had made a tax-free exchange, then she would have been able to help to avoid some of the taxes, but it doesn't look like there's any recommendation to do that. So her unethical sales practices involved a lack of suitability in recommending the surrender of an older annuity contract with considerable gain rather than its tax-free exchange. Furthermore, she failed to fully disclose the adverse tax treatments. Any questions? Let's look at Bob, and I'm sure there are no because it's the last hour and everybody's ready to go. Everybody's ready to go home or go to their somewhere else. Let's look at Bob and Carla, look at them for a couple minutes, and then we'll come back. Okay, let's look at Bob and Carla. They've been married for 50 years. They're retired. She's never worked outside the home. They want to avoid some income taxes. What do you think about the recommendations to sale of a deferred annuity? Okay. So there's no liquidity in the deferred annuity. There's short-term withdrawal objective and there's tax concerns. So the Barbara's recommendation in sale of annuity would fails the suitability test in virtually all categories: lack of liquidity, a short-term withdrawal objective, and tax concerns. Barbara's annuity sale wipes out the relatively modest amount of liquid assets Bob and Carla currently have and uses it to pay a single premium for the deferred annuity. If they have a financial emergency, they'll probably need to surrender their annuity or withdraw funds from it. And then they'll incur surrender charges, which could be substantial. He plans to begin taking withdrawals from the deferred annuity next year when he reaches age 75. In other words, they have a short-term objective for these funds. Surrender charges are likely to apply for at least 5 years and possibly longer. So when he makes a withdrawal, they'll impose a surrender charge. They said they wanted to avoid some of the income taxes they pay, and their income level would suggest their income tax is modest. The principal tax benefit from a deferred annuity is its deferral of gain until distributed. Now, if they're buying the annuity now and taking the money next year, you're really not deferring it. And using the money in the traditional IRA is likely to cause the entire amount withdrawn from the IRA to be considered taxable. So these are all things that we don't deal with really on an everyday basis, but it's things you could think about. Cheers. Also, somebody doesn't like pizza. Ooh. And I do get copies of the poll, so I'll know who answered and who I didn't get answers from. So I will certainly reach out if there's any other issues. Jim Whitaker is our next one. Let's take a look and see what he's doing. He's had homeowners insurance for several years. The policy provides full replacement coverage as if his house is destroyed. He just lost his job and wants to reduce his premium rather than be required to cancel his policy. As the person taking Jim's telephone call, you suggest to him that lowering his premium might be easier than he thought. Ha, ha, ha. Does the person taking the phone call even understand insurance? Yikes, yeah. Same person that doesn't want more MSO classes, probably, yeah. All he needs to do is reduce the stated value of his insured residence. Could possibly go wrong. He's delighted. By reducing the value of his residence, he lowered his annual homeowner's premium by $500. Oh, big whoop. And will be able to keep his coverage in force. What do we think about this? Bad idea. Even I know that Vicky doesn't sell insurance, property and casualty, like standard insurance, so auto. Let's hope her property. Let's hope the insurance carrier doesn't do an inspection or request a replacement cost estimate. I hope his insurance is current and paid. Bad idea. Try to find a company that will allow that these days. Not a good idea. Of course, if you had, some policies will give you the station needs to take an ethical class. Some companies will offer things like market value or actual cash value, but that has to be stipulated in the contract. Your standard contract says you're insuring to 80% of the replacement value, or you are going to suffer penalties. And they say underwriter won't allow you to just change the value of the home. Mary Shoemaker runs an insurance company, so she knows what it's like to see things like this, and she would say, she says, oh no, I would avoid ACV at all costs because you're getting yourself into trouble. How do you determine? You say, oh, it's actual cash. That's the house actually worth. Well, there can be numerous issues. So, and if you don't have, and if you've lost your replacement coverage, which means you're only going to get reduced depreciated coverage for any loss you have. Personal property coverage is also automatically reduced. I would hope the agent would have it in writing that he discussed what this coverage does and has the insured sign. Tell him to increase his deductible. My underwriters would request an updated replacement cost estimate. So these are all things that considerations and issues that are going to be coming involved when we don't have the proper coverage. So they're both coverage and disclosure problems in this solution that's proposed to Jim's problem. Under his policy, the stated value of his residence must be at least 80% of the actual property value in order for the policy to provide for complete replacement. By reducing the stated value to a level that may be lower than 80% of the true value, destruction of his house may leave a large part of the replacement cost uncovered. In addition to the reduction in the stated value of Jim's residence, the reduced limits will also automatically reduce the limits applicable to his personal property coverage. And other extended living or additional living expenses would also be reduced. And your exterior other structures coverage is also reduced. While Jim certainly should have been aware that his premium savings were the result of a reduction in his coverage, The producer needs to disclose all the material facts concerning the insurance transaction. Clearly, that disclosure did not occur. Any other questions about this analysis? Any other comments you would want to make? So we say this is not a good idea. Don't do it. Yeah. But these are the kind of things that you see. And you can see people with proposals and you say, oh, I had a client for 20 years. And they come in and say, oh, this guy's giving me this great coverage. Hope the CSR got fired. And if you see, and that's part of the benefit of having the comparisons and having the formal proposal instead of saying, I'm going to give you $500,000 of coverage and here's your deductible and here's your premium, sign here. All the ancillary, all the other coverage considerations. If you've got the formal proposal, you can sit down and you can compare them side by side and see, well, maybe there is a reason it's a lot more less expensive because they're not giving them any coverage. It's a fire policy. It's a dwelling policy. It's not a homeowner's policy. Your liability limit is 50,000 instead of $1 million. Whatever the consideration is or the case is, if you don't have the proposal in front of you to look at, you have no idea what you're selling against. So our next scenario is Joan. This is an automobile insurance scenario. So take 5 minutes to read it, go through it, tell us what your thoughts are. Hell to the no. Tell me how you really feel, Terry. Talk about someone needing an ethics class. Not a very bad idea, but a very bad idea. Anything that says the clients will never know is a red flag. Very unethical. Instead of being unethical, just let it go. Is the commission that much that you would risk this? Fired. Wow, extremely bad. Why would you want to keep someone with numerous claims? Wow, not good. Is your license worth it? Yeah, do you want to lose your license? You want to lose your CPCU designation? Let this crazy lady go along with the producer. All right, so Joan Kitts has been insured for automobile insurance coverage with the agency for a few years. Let them move their coverage elsewhere with that kind of driving record, and has been involved in several auto accidents during that time, resulting in numerous damage claims. Because of her driving record, the insurer plans to increase her premium substantially. The producer, realizing Joan will move her coverage to a competing insurer with poor claims paying history and ability, plans to reduce her liability coverage limits. By reducing the limit on her automobile liability coverage, she will be able to keep clients' premium at about the same level. Joan will never know, and the client will be able to keep coverage with a high quality insurer rather than one with a spotty claims paying record. Let them move their coverage elsewhere with that kind of driving record. Imagine what she does to her other clients. She's having these accidents. She needs to have higher limits. I'm surprised they have not dropped her. All good comments. So Jones Progressive would be the only carrier that would write the coverage and match the same coverage and deductibles. And just tell a client the carrier they're looking at is poor claims assistance and suggest other ways to reduce premium. Driver's ed classes, a bus pass, Uber. Yeah, the claims paying record is what's driving their decision. Yeah, so Yeah, there are other things to think about. So her poor driving record is about to result in a big premium increase. No kidding. Time to start walking. Yeah, good exercise, right? Since that increase is likely to cause her to move the coverage to another insurer, one with a marginal claims paying record, the producer has lowered her automobile liability coverage to reduce her premium. As a result, Joan will be pay just about the same premium, even with the increase. Problems that we see. I think we've hit quite a lot of them. It's dishonest, isn't it? It's misleading. It needs disclosure. And lack of disclosure, which all the things that we talk about, still, she's lucky if she does not get non-renewed, and still a bad idea. That's what gives the insurance industry a bad reputation. Wait till Joan has another accident and finds out her limits no longer cover her adequately. So, despite the producer's intention in reducing Joan's automobile liability coverage limits, doing so without informing the client is dishonest. It misleads the client by permitting her to think she still retains the formerly higher limits. The producer has failed to disclose the material facts of the insurance transaction. Clearly, a reduction in the amount of coverage must be considered material. Any other questions or comments that we have about this scenario? And I pose those, do you have a pet? I think I mentioned before that I have 8 chickens. I guess they're pets and a dog. And my husband, does he count? I don't know. You want chickens? They're fun. Husband definitely counts. You must have met him. Okay, let me see if I can get this. I can tell about some. So this is another some ethical case studies that are interesting. Find my list here. Okay. I had one that the 27% don't know what they are missing. Well, you may not, maybe you're allergic to pets. Maybe there's lots of interest. But this is one I found about some various ethical case studies that might or might not be of interest. But we'll go through. I have a personal one that I was involved in. My many years ago, I had my ex-husband was working in insurance, and his boss was a piece of work. Can we call it that? A piece of work? He decided that he would take the money that was supposed to go into, I guess, the pension fund or a 401k or Fidelity bonds or something that they needed to have in their office, and he was going to go to Atlantic City. Needless to say, things did not go well. And that money did not come back. Now, this man was a CPCU. So he knew better. He was also an alcoholic. Part of maybe was part of the problem. So he did a few unethical things. My ex did not have the chutzpah. Is that the word I should use? It politically correct to say anything or do anything, but I did because he was a CPCU and they have high ethical standards too. And that was not right because if he was doing that to his own cherished, devoted, loved employees, what was he doing to his clients? Where was their money going? So that was a personal one. Does anybody else have one that have been involved in an ethical situation that may or may not have gone well for you? Or I mean, what do you do? That's something we could consider too. What do you do when something like that happens? Do you speak up? Well, in my case, as a CPCU, I'm kind of required to. I mean, you're talking about if you know of something that's wrong that's happening, that's being done unethically, you have a responsibility to report it. And it doesn't matter if it's your friend or your best friend or your boss or your sister. Technically, you are required to report that information. Know something, say something, right? So we have a couple other ones that I didn't send to you, but I will talk to you about. Yeah. You're at your local agents association luncheon. A duty according to all those codes of ethics. Right, the codes of ethics. We've all got codes of ethics and codes of conduct for CP, whether it be CPCU or your other agents associations or professional organizations or IAIP, or even if you're a lawyer, you've got legal ethical requirements. It's a duty that you have, and that's kind of where the rubber meets the road, isn't it? With where you when you know something, and what do you do, and how do you feel about yourself if you don't say anything? And what if that situation gets bad and things really go badly? He had another boss who was not in the insurance industry who also liked Atlantic City and was a nightclub owner. And he went to Atlantic City and he lost everything. So what happens? I mean, if you're his insurer and you know that this guy's in my financial trouble, if you're his agent, if you know this guy's in financial trouble because he doesn't have any money because he's spending it all in, yes, addiction is terrible. He's spending all his money gambling. I mean, he was so bad that he would be down up $5,000 at 4 o'clock in the morning. And by 6 o'clock in the morning, he would be down 10,000. So he had a $15,000 swing in 2 hours. So he wasn't taking care of his business. He wasn't doing the repairs he needed to do. He was probably shorting things on other things, maybe safety precautions. And those are all things that are going to impact the insurability of that business. It ultimately went bankrupt. What a surprise. But say you're at an agents association luncheon, talking to your other friends, talking to your competitors, and one of your friends says, his production's slow. One of his best CSRs is moving away. If he doesn't increase his production significantly, he's gonna lose some of his companies. His biggest account is renewing in a few weeks. He hopes he doesn't lose it because he doesn't know what he'll do. And you happen to have a proposal on your desk for that same account that you're going to deliver, and you feel that your proposal is better than what your friend has, but you feel bad because your friend is also your friend, and you know what it's like to go through bad times, and we all have ups and downs, and it's not as crucial of an account for you as it might be for him. So do you tell the client, I can't help you to stay where they are, even though you know that you can do better for them? Or do you help your friend, or do you help the account? What do you do? Those of you who are actually producers, I think there's some of you there. But that's a dilemma that you could face, right? Tell the truth. And maybe do you tell the truth to your friend? Do you say, "Hey, I've got a proposal that for the same client, I can do this." Yeah, maybe share your proposal with your friend. Show him where you can help. With new business, I would tell him to get in his apps first, so he'll be the one to get the policy. But renewal, not sure, And it was apparently it's a renewal that he's worrying about. If it goes somewhere else, he could go out. He could really have a serious problem. Well, I'm happy to say that everybody said that they learned something today. Yay, my work here is done. So that's one ethical issue. There are others. If you're a field underwriter, one of your top, we talked about this before, the client can get the same coverage somewhere else. Well, and maybe your friend, the producer, can do it, and maybe you can help out. Maybe in the future that will help them. They can help you in some ways because we often come into situations where maybe I can write something, but there's a part of the risk that I can't write. I know that Vicky works in special risks and special businesses that not normal P&C insurers aren't going to do. So. Thanks for sucking up, everybody. I appreciate the kudos because I am not always comfortable doing these, and I know ethics is not everybody's top 10 classes they want to take. Okay, so we got another one. We're an agency. We got a few more minutes that we need to fill up, so I'll give you a couple more ethical situations. We talked about trips. I remember us rewriting coverages and bot policies for insurance because whatever the company was, it could have been Aetna or Hartford or whatever was offering a cruise to the best producers, and my boss decided that was what he wanted. So they were all excited about it. So in addition to the property and casualty premium required for the life agency to qualify, you have to have added a life insurance policy for that with that carrier. No matter how much P&C they write, the life policy has to be written during the qualification period or your agency's not going. And your agency hasn't written a policy because their coverage isn't that good. I mean, not all policies are the same, as we know. Even you have to read your policy. Some of us make a living by reading and analyzing policies and figuring out what the coverages are. And if you look at some of these policies, they look great on paper, they look great or online. Surplus lines policies definitely are scary because they're all manuscript. But even some of the standard ones, like some of the, I'm not naming any company names, but you've got some of the ones that are advertised quite a bit that may, if you actually read the policy language, which I have a friend who has done that and says, oh, there's some things in some of these policies that would scare you because they're not standard policies, they're their own policies, and that's why they're cheaper than some of the ones you can get. And that's why, those of us who work for independent agencies understand why an agent is so important because you can provide the information, you can provide the comparisons. You're not just clicking on a button on a screen saying, "Oh, I have a car. I want it's this is how far I drive it," and getting a quote because there's so many other things. Well, how else do you use it? And some maybe if your car is used for Uber or if your car is rented loaned to somebody, there may be conditions that you can't do it. So you can't believe they haven't been up a single policy with this company. And they called and asked about it, and the agency said quite clearly, your company's life insurance policies are among the worst in the business, and they can't ethically place any of their clients with you. And they find it hard to believe you would disqualify them from the trip, considering the amount of P&C they place with you. So you talked to one of your coworkers and said, call them up and tell them to write a policy on you. When you question the wisdom of this and also point out you really don't need another life policy, if coworker writes, well, then you tell them that you aren't going on a trip, and a couple of my agencies were in the same boat, so I bought policies from them. Nothing extravagant, just enough to qualify for them for the trip. You know they deserve to go. So what do you think? What would you do? Alana, I'll enter the provider number because it's different for each state. And your national producer number is tied to your license number. If it's not, if you don't have it, I can look it up. So what will we do about this life insurance policy? What requirement? Do you make them write a policy? Do you tell them they can't go? Do you try to maybe get your policies fixed, improved? Because I mean, there's obviously the requirement. There's a life insurance policy means they're not writing a lot of life insurance, and there's, as the agent said, it's probably a reason. So that's my story, and I'm sticking to it. Miss Seitz?
Yes, a few words. First, thank you to all the attendees. Ethics is a long, long slog, but Sue did a great job, and it was great. You were all interactive, and that helps. That makes it more interesting. So
Thank you. Thank
wonderful.
you. Thank you. Thank you.
And Sue did a great job. I want to plug the CE school. Remember, 41 states and county. And Sue is always looking for ideas for articles and writing, etc. So if you think of an issue, that would be great. We also have Underwriters Corner, which is a little bit more slanted, I would say, towards the claims side. But thank you all for attending. And Sue, I think, is going to give you the plug for our next set of webinars. So, Sue, you want
Yes, I am, ma'am.
to?
Well, as a 501(c)(6) corporation, part of our mission is to give back to the industry, and that is why we offer free CE to anybody who wants it. We're offering at least 10 credits this year, including this 3-hour ethics course that you're also so lucky to attend today. We welcome suggestions for presenters and topics. If you miss any previous webinars, they are all available for on-demand viewing on our website. You don't get credit for them for CE, but they are some valuable information. They will also be available on our YouTube channel, and you have seen the links for those posted by Cassidy in the chat, where you can contact me if you have questions. Please subscribe to our YouTube channel. It's free. And you may also have seen our training flyer. We offer CE and non-CE training for member companies, agents, any other industry members, lawyers, but we don't have lawyers CLE, but we do offer it to them to be provided in this. Our goal is to be licensed as a school in 50 states plus DC. We're currently at 41 jurisdictions as of 2 days ago, when we got Michigan and Montana. Contact us for more information or a fee schedule. If you're looking to run courses for your employees or for your agents, we're happy to talk to you. If you'd like to be included on our mailing list, shoot me an email. Roofing inspections and coverage considerations. Our own Mary Beagle and Nils Deacon will be talking to us on April 8th. That's another 2-hour CE. On May 21st, Wildfires, What to Know and What to Do is 1-hour CE offered by Seth Burstein of Red Zone. They specialize in wildfires. And October 14th, we'll be talking about artificial intelligence and insurance by what insurers need to know, whatever that currently is needed to know back in October. They haven't finalized that presentation yet, but that's a 1-hour CE presented by Dave Pitney, Elizabeth Reddersdorf, and Ashley Picker. And I will finish the year. If you love my presentations, you can come back again on November 17th with 3 CEs on emerging issues. In addition, if you have some emerging issues that you think would be good for the class or you'd like to learn more about, please let me know, because I'm still working on updating that presentation. Information on all of our programs is available on our website, msonet.com. As Jan mentioned, we have over 200 articles that are available for your use. You can share them. You can give them to your agents. You can use them in marketing. We can update them. We always look for ideas for new topics. Once again, we'll thank all of our sponsors. Thank you for everyone for attending. Special thanks to our team, Cassidy, Mary, Maria, and Barbara, who will make this all possible. And we'll be sending out your certificates and help today in the presentation. Please complete the survey and course evaluations that will be sent to you. And if you have any questions or issues, you've got my contact information. And I want to thank you all again for being here. And have a great rest of your day and rest of your week, and hope it doesn't snow too much.